You've heard it 1,000 times. This stock is trading at 30 times earnings. That one looks cheap at 12 times. But what does any of that actually mean? And should you care? Hello and welcome back to Ticker Talk Concepts. Today we're breaking down one of the most commonly seen word in the investing world, PE ratio. One metric, two numbers, and somehow infinite arguments. Let's get into it. The formula couldn't be simpler. Take the share price, divide it by earnings per share, and you get the PE multiple. So if a stock is trading at $150 and the company earns $6 per share, your PE is 25. Here's the framing that actually makes it click. A PE of 25 means you're prepaying 25 years of today's earnings, up front, right now, before the company grows a single dollar more. Flip it around and you get the earnings yield. At 25 times, that's 4%, roughly what you'd earn if profits never moved. The moment you pay a PE above that, you're betting on growth. Now here's where most valuation arguments quietly fall apart. There are two versions of PE, trailing and forward, and people use them interchangeably without realizing they're measuring completely different things. Trailing PE uses the last 12 months of actual reported earnings. It's factual, it's grounded, it's what happened. Forward PE uses analyst estimates for the next 12 months. It's speculative. It reflects what the market expects to happen. For a mature, stable business, trailing is your friend. For a high-growth name where today's earnings bear no resemblance to next year's, forward is more relevant. The catch? Estimates can be wildly wrong. And markets are always pricing forward, not backward. So know which number you're looking at before you draw any conclusions. So what's a good PE? It depends entirely on what you're comparing it to. Think of it as a spectrum, green on the left, red on the right. Deep value territory sits below 10 times. You're either getting a bargain or the market is pricing in serious trouble. Utilities and financials typically sit in the 10 to 18 times range. Consumer staples and the broader S&P 500 average cluster around 20 to 25 times. Tech names carry a growth premium. 25 to 45 times is common. And hypergrowth or AI names. You can easily see 40 times, 80 times, even higher, because the market isn't paying for today's earnings, it's paying for the earnings it expects 5 or 10 years from now. A PE of 30 can be cheap for one sector and expensive for another. Always benchmark to the peer group. Before you run off and screen every stock by PE, there are 3 ways this metric can lie to you. Trap 1, negative earnings. If a company is losing money, EPS is negative, and the PE ratio simply doesn't exist in any meaningful sense. Don't try to read it. Use EV over sales or EV over EBITDA instead. Trap 2. Buyback distortion. When a company buys back its own shares, the share count falls, which mechanically increases EPS, even if total profits are completely flat. A shrinking PE can look like improving value when it's really just financial engineering. Trap 3. Cyclical timing. This one trips up even experienced investors. For energy companies, miners and banks, PE looks cheapest at the top of the cycle when earnings are peaking and most expensive at the bottom when earnings have collapsed. The opposite of what you'd intuitively expect. So here's the bottom line. PE is not a buy signal. It's not a sell signal. It's a translation tool. It converts price into a statement about belief. A high PE says the crowd believes earnings will grow significantly. A low PE says the crowd is skeptical, cautious, or just not paying attention. Your edge as an investor is not finding a low PE. It's deciding whether the crowd's belief is right. That's Ticker Talk. Take care, and I'll see you next episode next week.